Okay, let's dive right into this. Right now, there's this absolutely fascinating mystery playing out across global financial markets. U.S. Treasury yields are edging lower, and investors, well, they're quietly but rapidly retreating into the safety of government bonds. But why? What do they know that the rest of the market is waiting to find out? Welcome to this explainer, where we're going to crack the code on this whole market movement. We'll explore exactly why the financial world is basically holding its breath ahead of the FOMC, that's the Federal Open Market Committee's meeting minutes, and how a few sheets of paper in Washington could literally end up rewriting the rules for your personal finances. Here's our roadmap for today's explainer. We're going to start with the market's current waiting game, unpack the mechanics of U.S. Treasury yields, and then decode those highly anticipated FOMC minutes. From there, we'll trace the ripple effect across global markets, and finally, bring it right home to what this all means for you, the consumer.
Section 1. The Market's Waiting Game. Cautious Moves Ahead of the Fed.
Moving to Section 2. Unpacking U.S. Treasury yields. The mechanics of government debt.
So let's get into it. Treasury yields basically represent the return you, or any investor really, gets for holding U.S. government debt. Because the U.S. government backs these securities, they are universally considered among the safest investments on the entire planet. But, their importance goes way beyond just being a safe place to park your cash. Because they carry practically zero risk of default, Treasury yields act as the baseline, the ultimate benchmark really, for the cost of borrowing money across the entire economy. Literally, every other interest rate you encounter essentially builds right on top of this foundation.
And this brilliantly illustrates one of the most vital, yet honestly frequently misunderstood mechanics in finance, the relationship between bond demand and bond yields. Think of it like a playground seesaw. On one side, you've got bond prices, which are driven by demand. On the other side, you have Treasury yields. When markets get nervous or, say, uncertain about the economy, investors rush to buy these super-safe government bonds. This massive demand pushes the price of the bonds up. But here's the catch. Because the bond pays a fixed amount of interest, paying a higher price for it means your actual percentage return, the yield, goes down. The seesaw tips. So, falling Treasury yields, kind of like what we're seeing right now, are a giant flashing indicator that investors are feeling cautious and buying up safety.
Now, this dynamic builds across different time horizons. Not all treasuries are created equal, right? The market uses different maturities as very specific clues. Take the 2-year yield. It's highly sensitive to the immediate future. It's essentially a mirror reflecting what investors think the Fed is going to do with interest rates in the short term. Step out to the 10-year yield, and you're looking at the ultimate benchmark for long-term economic growth and inflation expectations. This is the big one. It influences things like your 30-year fixed mortgages. Finally, the 30-year yield reflects deep, long-term confidence or, lack thereof, in the structural health of the U.S. economy. So when yields across this entire board decline, it's the market collectively signaling expectations of slower growth, lower inflation, or maybe a Fed that's about to make money cheaper to borrow.
Section 3. Decoding the FOMC minutes, the ultimate case files. Okay, so the Federal Open Market Committee meets regularly to set monetary policy. But the official statements they release right after, they are incredibly brief. It's not until 3 weeks later that they release the minutes, which is a detailed summary of who said what and, frankly, what they argued about. So the big question is, what exact clues are investors frantically searching for when these pages finally drop? Now, what's really interesting about this slide is that analysts don't just read these points for general themes, they actually deploy algorithms to parse the exact adjectives used. They want to know the absolute depth of the Fed's inflation concerns. They're looking to see if officials believe current rates are choking the economy too much or maybe not enough. Are there disagreements? Because a divided Fed is a total wild card. They're looking for acknowledged risks to employment and, crucially, any tiny hint at the timing for future rate cuts. Even a subtle shift in a single sentence here can literally trigger billions of dollars to move in milliseconds. It's wild.
But at the core of all those discussions is one word: inflation. It is the final boss the Federal Reserve is fighting. The Fed's mandated target for long-term inflation is 2%. And yeah, while inflation has cooled significantly from its peak, it's still kind of lingering above that target. So the Fed is caught in this massive high-stakes balancing act. They want to lower rates, sure, but recent data shows a surprisingly resilient labor market and really strong consumer spending. And while that strength is great for workers, it keeps demand high, which, you guessed it, keeps prices high. The Fed needs to see convincing evidence that this final boss is totally defeated before they can safely lower interest rates. Section 4. The ripple effect on markets. How the FOMC moves the world.
This whole chain reaction plays out in 4 steps. It starts with a stone dropped in Washington. Step 1. The Fed hints at their policy in the minutes.
Instantly, step 2, Treasury yields react, either spiking or dropping based on those hints. That shift in the safest asset on Earth triggers step 3, which is a massive reallocation of capital across global stock and currency markets. And finally, those global waves crash right onto Main Street in step 4, actually changing the rates that consumers like us pay for everyday loans.
Now, there's a real dual nature to falling Treasury yields. The optimistic view is that falling yields mean the Fed is going to cut interest rates. Cheaper borrowing costs mean companies can expand for less money, and future corporate earnings look way more attractive. This usually boosts stock valuations, especially for your big tech and growth stocks. But there's a flip side. The cautious view warns that if yields are falling, it might actually be because the smart money in the bond market sees a nasty economic slowdown on the horizon. And if the economy slows too much, corporate earnings will tank, taking stock prices right down with them. The stock market is just constantly agonizing over which of these two narratives is the actual truth.
And hey, it's not just domestic stocks either. U.S. Treasury yields act as the gravitational pull for the entire global economy. When U.S. yields go up, foreign money floods into America to capture those high, safe returns, and that strengthens the U.S. dollar. But when yields drop, kind of like they are right now, the dollar can weaken as capital flows out looking for better returns somewhere else. This puts immense pressure on emerging markets and literally forces global central banks from Europe to Asia to adjust their own policies just to keep up. It's a huge domino effect.
Section 5. What this means for consumers. Main Street impact. So the crucial point is this. Fed policy eventually hits your wallet. That intricate dance between the FOMC minutes, institutional investors, and global bond yields, that is the exact machinery that determines the cost of living for everyday people.
When Treasury yields move, they drag all these consumer products right along with them. If the Fed signals they're winning the inflation fight and yields drop, you're going to see mortgage rates become more affordable, which really opens up the housing market. Auto loans get cheaper. Those punishing interest rates on credit cards might finally ease up a bit, and local businesses can actually afford the financing to hire more people. But on the flip side, the yield on your high-yield savings account, yeah, that's going to drop too, meaning less passive income for savers. It's a massive economic lever that touches almost every major financial milestone in a person's life.
But getting to those lower rates isn't guaranteed, not at all. The Fed is walking a major tightrope right now, and these are the lingering risks that keep policymakers and investors up at night. Persistent, sticky inflation is still a very real threat. We're also looking at a backdrop of slowing global economic growth and some highly unpredictable geopolitical tensions. Throw in a labor market that just refuses to quit, plus some mixed corporate earnings, and you've got an incredibly complex puzzle. Any single one of these factors could force the Fed to change course, which is exactly why the market is so hypersensitive right now.
Which leaves us with this final pivotal question. Is the market's current caution, this big rush into the safety of treasuries, is it a sign that inflation is finally cooling, paving the way for a booming, lower-rate economy? Or is it a dark warning of an impending economic slowdown? The FOMC minutes are going to offer the first major clues, but the real answers will unfold in the upcoming data reports on the Consumer Price Index and GDP. So keep your eyes on the data, because this mystery is far from solved. Thanks for joining me on this explainer, and as always, stay curious.